Hey everybody, Chris Parry from Equity.Guru. This is the Gauntlet video series where I hold the feet to the fire of various public company CEOs. And today we've got Southern Energy, Ian Atkinson. How are you, man?
Great. Nice to be here. Thanks for the invitation.
Not a problem at all. So I would say of all the companies that are out there doing their business that I get emails about saying, hey, can you do a piece on Southern Energy? I get more asking about you than I think anything else. That might be that Mo Elsegear is a relentless promoter of your company. But
we're trying to get a good audience, so I like to hear that.
It's you know what, he's getting out there. Like when everything else has been dying on the vine in this economy, you guys have been returning profits to your investors on a pretty regular basis. I know oil and gas has gone through some upward swings, but there's also a lot of people out there that sort of point to oil and gas and say there's a limited time frame on this sector, that we're moving towards EVs, that we're worried more and more about climate. What is the long-term outlook for Southern Energy, in your opinion?
I think natural gas is quickly becoming part of that green initiative. It's going to be part of this electrification of the vehicle fleets. Case in point, myself and our COO were marketing in London about 2 or 3 months ago now. And as we're heading there, we caught some news that was quietly being put out there, which was that the European Commission was allowing for major natural gas investments to be viewed as green. So that means those European governments could invest in natural gas-fired power, major projects, and have those dollars come from green financing. I think that's very key, not for the next 2 quarters of natural gas prices, but for the next 10 years. And you have to compare burning oil or burning coal to burning natural gas to create electricity. It is much, much less carbon intensive. So I do think natural gas will be front and center in the green initiative in the next 10 years, hands down.
So that's I guess the long-term output for you is there's always going to be oil needs, even if we're not sticking them in the F-150, but the natural gas really is the future. And there's no reason to think that you couldn't be making more money 10 years from now than you are today.
Yeah, and I think you invite more investment if you can be part of that green movement, which certainly is gaining momentum. And then where our assets are in the southern Gulf Coast of the U.S., we have access to global markets now with that LNG export business. If we had natural gas assets stranded in Canada because of the lack of access to those global markets, I wouldn't be as excited. But where we are literally 90 miles from Henry Hub, which is that gateway to natural gas hitting global markets from the U.S. coast.
When we first started talking about you guys, I think it was late last year, you were maybe a $20 million company around there.
Yeah.
Now 60, 70 million. You've just raised 30.
Correct.
That's a pretty good upward trajectory in one of the worst markets in the last 20 years.
I'd like to say we're an overnight success, 8 years in the making. People that maybe don't know us well, we've been working these assets for over 7 years and have been focused on the Gulf Coast, accumulating these assets, but in a private equity structure. So it may seem like, where does Southern Energy come from? How have they gone from a $20 million market cap to 70? And we're trying to convince people we're going to be $1 billion market cap here as we start to develop these assets over time. But that hasn't been overnight. That's been, 7, 8 years of hard work through low gas prices, being very conscious on profitability, setting ourselves up for acquisitions. And then you hit the nail on the head for us, finally having access to capital. And that $30 million raise was US dollars, was very key for us to get into this next phase of our growth, which is going to be continuous organic growth at the same time as I think we now have opportunities on some inorganic growth as well.
So those that look casually at charts as they're looking through the 2,000 or so on their watch list would see your $1.50 to 84-cent drop over the last few months as being a negative. When you factor in the fact that so many people would have been selling your stock to buy more in the financing and get their warrants, it's kind of almost a false drop, don't you think?
I do. That is probably one of the fallacies still in being a dual listed company. We're listed in London, as you well know, and we spend a lot more time trying to marry those two processes. But appreciate you're working in 2 time zones, 7 hours apart, 2 different currencies that fluctuate on the hour. You have 2 different jurisdictions of financing that have very different processes. And we're trying to marry those up as best we can with when you announce and when you close. And the tighter time frame you have, the better. And I think the word got out a little bit, I think, when it shouldn't have, that we were looking at financing. And I think we got a little bit of a lower price, but we also had some macro events that affected after we announced our financing, i.e. there was the US recession, interest rates hike. We had a fire at an LNG facility in the US. All those things, unfortunately, were kind of in the mix, but we felt we did consider not launching the financing because of those market macro events, but we felt pretty strongly that the markets were here now, and if we didn't raise this capital and had nothing to talk about for 6 months, we're pretty sure our share price would have been lower than 87 cents. Sure. So at least now that's a new floor for a lot of people coming in. I think where we were trading before in that $1.30 range was fair, but now we have the capital to go much, much farther beyond that. And we're going to start spending that here in about a month and a half as we start moving the drilling rigs again.
So now you get to buy the stock at almost a 50% discount from its high, while the company is better financed and better armed to go forward.
And in a better macro environment. And one thing I wanted to point out today as we're speaking, so during our financing and anytime we've marketed Southern Energy, we've always told investors that we're a company that gets Henry Hub or NYMEX, those words are interchangeable, gas pricing at par at our wellhead, which is true, it's factually true. Those aren't physical price points. We physically sell our gas into two different pipeline systems. One's called Transco, and one's called Southern Natural, which is shortened to SONAT. Something interesting has been happening there in the last few months, which is those two pipelines are now trading at a pretty significant premium to NYMEX. So from caveman days to call it 6 weeks ago, Transco and Sonat traded at NYMEX minus 5 cents to NYMEX plus 1 cent. So call it par. Mm-hmm. Well, now Sonat and Transco, specifically Transco Zone 4, which is where the majority of Southern Energy sells their gas, is at a $3 to $4 premium US per MMBTU. So when you see an $8 NYMEX gas price, we're now getting $12.
Okay.
And that's significant, especially as we are now capitalized and launching into very significant growth again. So right. I want to make sure that people understand that. So that's key. That's a 50% premium to NYMEX, and that's an even wider premium to any Canadian producer that attracts an AECO pricing.
So what does the next 6 months look like for you in terms of news flow? Like, what is the 5 words that you would say would describe where you're headed in the immediate future?
I think it's going to be the growth of production, the growth of cash flow. In this next drilling program, we're going to be drilling 3 different formations. So the first 3 wells we drilled and we announced here kind of during our financing, we're targeting one zone called the Upper Selma Chalk. We also have another zone called the Lower Selma Chalk, and then a third zone called the City Bank. Now, the previous owner, EUG, which is one of the biggest resource developers in the world, they had drilled vertical and initial horizontal wells in all 3 zones, albeit with technology of 10 plus years ago. So we kind of proved our concept of current technology on the Upper Selma Chalk. But now as we go into this next phase of drilling, we'll drill all 3. So that's when you start to see some very significant 1P and 2P reserves growth, which is really the backdrop of what supports your share price along with your cash flow, obviously. So you'll see some pretty significant growth. I do think with having our liquidity, I mean, we are working on renegotiating our credit facility to allow us to do more things as well. So I think you'll see both organic and inorganic growth from Southern in the next 6 months.
Okay. So I think a lot of people sort of focus on the oil element of oil and gas, and you sort of stuck with that stigma of it's good now, congratulations guys for squeezing us at the pump, but eventually you're just going to be gone. But you make a really good point on the gas side of things that certainly in Europe, as we're seeing, that gas is all important. It's bringing countries to their knees, I personally would love to see nuclear energy being embraced more, but we're probably 15, 20 years away from that. So there's a really rich vein, no pun intended, to be tapped by going into that natural gas space. What is the prospect for you for rapid growth? Are you just playing out the existing space you have, or do you have an eye on the horizon for the next big thing?
Oh, I think it's both. So when I refer to organic growth, that's kicking off in Gwinnville again. Starting a 1 rig program there early in Q4. So that organic growth, I think, could be very substantial. I mean, we put out a target of 25,000 barrels a day publicly here a few quarters ago. These first 3 wells have us, well on our way there. But I think we can certainly get there over the next 18 to 24 months with drilling. But what you said is the next big thing for us. We have a fairway of interest, which is central Mississippi, northern Louisiana, East Texas. This is where I feel we have a competitive advantage. We have a proprietary database of digital geologic data. So we can look at acquisitions and we can map zones very, very quickly. And through COVID, when oil and gas was certainly out of flavor, part of our company was focused on maximizing profitability with dropping costs. The other half of the company was working on potential acquisitions. We've done well over 150 asset evaluations in that very specific geologic fairway. And now with this access to capital and renewed interest in this space, I think we can transact on some of those. And that's where you see the step function growth in those inorganic.
Is there a land rush happening in that space? Are the people similarly looking at, or have they waited a bit too long to get to the front?
There really isn't. Not to say there's no competition, but there's not a lot. Certainly not a lot of publicly listed consolidator growth companies like ourselves. A lot of the U.S. companies are still very focused on the shale plays, but they're much larger companies. They're large public companies. They're large private equity-backed companies. And so I do think that we are sort of the early mover and do have an advantage in these areas with our business plan, which is to acquire conventional assets that are low decline, but haven't had capital spent for 10 plus years. So still a lot of organic opportunities within that, but you're only paying for what's producing today, right? So you get all that upside for free that you then get to capitalize. So you're buying something stable and low decline, and then you have that substantial growth. So it should be the perfect match, I think, right now to the macro backdrop of natural gas.
I don't know if you're a baseball man or not, but your business model reminds me of the Oakland Athletics. Going out there, looking at things that the market has overpassed. Moneyball, exactly. Looking for guys that throw funny, spend a bit of time fixing them up, and turn them into the stars that they can be.
Yeah, and it's nothing new for our team, and we kind of joke about it often, where we follow around big companies and pick up their scraps and things that don't make their threshold for size, but are still technically very and financially very profitable. For a company like us, that's a perfect building block for us. One comment you made earlier about oil versus gas. I mean, historically, gas was, it was here, then it wasn't as far as pricing. That's when gas was a North American story because you couldn't get it off the continent, right? So gas historically has always been a North American demand story. If demand was up, gas prices would go up. If demand was down, the prices would go down. And you were kind of bound between $2 or $1.50 and maybe $2.50. Now that you're sending, out of the US, you're sending 15, 16 BCF a day off the coast, mostly off the Gulf Coast of the US. They're adding another, call it 10 BCF a day in the next 10 years. Now natural gas is a global commodity. It competes with oil, but it's much cleaner in the carbon intensity. So that's why, again, I do think there will be nuclear. I think you're right. I think that is probably a little bit more longer term, and there's still social issues around that are very near in people's memories. But natural gas, I think, is going to be front and center in that discussion and that supply of clean fuel.
Have you always been an oil and gas guy?
28 years.
So you've been through it. You've been through
the ups and the downs. I did grow up on a farm working for my family farm. So I learned how to work there, but it's been a lot of hard working in the last 5 years here.
I sort of go on the theory that, steel sharpens steel. When times are tough, you get better at what you're doing. You manage to survive through the downtime so that when the uptimes come, your wheels are already turning. And that sounds a lot like what SOU was doing during the last downturn, not cutting everything away to save the limb, but, preparing for when the wheel comes back around the other way.
100%. Back then we cut corporate salaries 25%. We cut field salaries 10% without even having our board ask us to do that. We maintained that for almost 2 years. We didn't sell any of our office furniture or anything like that, but no one trying to be funny there. But yeah, we were focused on profitability. And I think that has certainly made us stronger because as commodity prices bounce back, your G&A doesn't bounce back. And that's something we pride ourselves on is, as we grow ourselves to 20,000 barrels a day, our G&A just keeps getting less and less and less on a BOE basis because we don't need to add a lot of people.
So a $70 million company with 30 million bucks in the bank, very little risk, money coming in the door, product going out the door in a sector that's hot, in a sector that's necessary. Where does the risk lie, if there is any?
I was just going to say, you're missing the risk conversation. So us having these assets, and I'm going to focus on Gwynville, which is where we have been focusing our capital. And we said this in our presentations previously, between the two formations that EOG had been drilling, there's about 2 trillion cubic feet of natural gas in place discovered with a 10% recovery factor, because they drilled it vertically first and they drilled it very inefficiently with the initial horizontal wells. They've shot a 36 square mile 3D seismic over the entire field. So all we're doing now is going back and applying current technology in drilling and completions to extract that gas in a more cost and capital efficient manner and more financially rewarding for shareholders. So there really isn't a lot of risk. There's always risk when you put a drilling bit in the ground and turn it to the right, mechanical risk, we call that. But geologic risk is negligible. The gas is discovered, the gas is producible, it's been proven. We've further proved the concept on our Gwynville program that we talked about a few months ago, that these modern completion techniques are much, much better than what had been done before. So we are an asymmetric risk reward company. And don't forget, we're in 90 miles from Henry Hub, where that's the promenade to natural gas hitting the world markets from the US. So it's where you're building your company. It's when you're building your company, when in the macro of gas environment, which I think for the next 10 years is going to be higher prices. And it's the type of assets you have, which for us are conventional assets that are very low risk.
So unless people stop using oil and gas tomorrow, or there's a monumental catastrophic economic event, you guys are in really good shape to just power through the next few years.
Yeah, I believe we are. And we had a few conversations with shareholders that didn't like the price on our financing. Let's be honest, it wasn't the price that we had hoped for. We thought it'd be a little higher. We got caught up in the macro environment a little bit, but felt that the timing of the financing was more important than 2 or 3 or 4 cents on the financing. I don't want investors to feel that we don't take that seriously, but to have the capital now on our balance sheet to now and hit that growth going into winter, typically gas prices are much higher. But don't forget, now it's August 1st, call it tomorrow. If you look at NYMEX pricing right now, it's $8. We're getting $12 to $13 at our wellhead. So that's in August, where it's typically low. I think we're going to see higher prices going into winter, and that's right when we're going to be bringing on this second phase of our drilling.
Obviously, oil and gas prices are cyclical. When things are high priced, a lot more taps get turned on, and suddenly it's low price because there's more supply. Where's the line where it becomes really difficult for you on pricing?
When we put these assets together, which was, call it 2017 to 19, from our private company to public company transition, we always said when U.S. gas prices were around $3, so call it, I think $2.85, we had a 35% return on invested capital. That would make sense for us to drill, and that there's been some cost inflation, no doubt, in the current inflationary world we're in, with drilling rigs, with the cost of services, with the cost of steel, that kind of thing. So that's probably $3 to $3.25. Now, anything above that, we will be spending capital to drill our low risk but high reward wells and be a growth focused company.
Right. So up and away. Up
and away. The other thing too is most of our hedges roll off here at the end of the year. We did have some legacy hedges from 2021. So then after January 1, the only hedge we'll have is a costless collar with a $20 per US MMBP BTU ceiling. So if gas prices hit $20 and I have to pay on that, I'm very happy, and so are our investors.
Right.
Otherwise, we're completely exposed with our base production and our production coming online here from the drilling program to what I think is going to be higher yet gas prices than we have even today.
I sense a little bit around the Canadian resource sector that there's a little cross-pollination starting to go on, or at least plans for it. Like there's oil companies that are starting to take a little interest in lithium companies. There's, gold companies that are also interested in cobalt. And do you, from your chair, do you look at other resources and say that there may be a natural affinity in other places in helium or things that you can drag out of your existing wells?
So I'm going to say we stay very focused on growing our asset in its core business, which is natural gas. But we do have deeper wells, and we're very aware of some processes that aren't too far away from us, where they are extracting lithium out of some deeper wells, and you basically cycle water back to surface. So we do keep our our eye on the ball there to see if our assets would fit into any of that extraction. But for the most part, we're certainly focused on core business.
Sticking to your knitting.
Yeah.
Good enough. Look, man, this has been a really great chat. I'm happy we got a chance to talk, and let's do it again soon.
Let's do it again soon. I like this format. Certainly if you represent some of the questions out there, and if there's positivity or negativity, I do want investors to think we're available and connected. So I appreciate this medium to address some of those questions, Chris.
Beauty. Thanks, man. Let's talk again soon.
Have a great day.